Welcome to the daily update, where I'll go over the action in the market for Friday, September 5th, and we'll see how things look for Monday, September 8th. All right, the much anticipated employment report came out. It did show weakness. It's pretty much locked in this idea that the Fed's going to cut rates. If you look at the numbers, and I go over them in the weekend video that I do every week. I do a lot of weekly videos, but there's a 100% chance that the Fed's going to cut rates. It's just by how much. And pretty much locking into this idea that there's going to be a 25 basis point cut or 1/4%, with more cuts coming as the year unfolds. And that was pretty much solidified with the weaker than expected employment report. The fear was that if it's stronger than expected, that would lessen the likelihood of a rate cut because that's what the Fed's been using to justify keeping rates higher for longer. But if it was weaker than expected, it's like, oh my gosh, the economy's falling apart. Because we have to look at the context. Why would the Fed be cutting rates? Right now, with everything that we've seen, it looks like the economy's doing pretty good. We had the ISM services number that came out on Thursday. That was stronger than expected. And we're going to be getting some more inflation data in the upcoming week. But at this point, the economy's doing well. It could be doing a little bit better. So the Fed's going to come in, cut rates for that reason, just to tweak the economy to help it perform a little bit better. And so that's more of a positive context instead of the economy falling off a cliff. All right, let's go back and talk about what happened. We had a gap higher open above R1 at 65.21, but that set the intraday high right there. And then we quickly, and one thing that I was trying to point out over the last video or so is that, okay, the market had been going up in anticipation that Friday's report would be weaker than expected. It came out, it was weaker than expected, and then we saw a sell-off after that. So it was more like buy the rumor, sell the news kind of a thing. That's kind of how things unfolded in Friday's session. So we declined, instead of the unchanged level acting as support, we just went right through it. We ended up going down. We dropped below the daily pivot at 64.84, S1 at 64.65, and then we found support at a round number, 64.50, and that set the intraday low. Then we bounced back above S1, and it was rather choppy. We were going up, we were going down, but we closed slightly below the daily pivot, and we were down still 0.32%. And this is something we haven't seen in a while. Not truly robust volume, but above average volume where we have consistently been below average with volume. There was a lot of anticipation in Friday's report coming out. So we're still positive on all three time frames, and we're above that longer term resistance. On a weekly chart, we've finally been able to get above that. And now the question is, can we stay above that? But for the last 3 weeks or so, we've been dealing with that 64, 68 level. We closed not much above it, but we did close above it on Friday. And interest rates are really coming down. We're seeing a big drop in the 10-year yield, and I'll show you that chart later as well. So we did set an intraday high with the S&P, but not a closing high. And it did close back below 6,500, where we were above 6,500 after Thursday, but above that 64.68 level. So there's some good and bad in all that happened there, or positive and negative, I should say. The Nasdaq ended up setting an intraday all-time high, not a closing high, but an intraday high, but the Nasdaq 100 did not. And we've been seeing that throughout the spring and the summer. We've been seeing the Nasdaq 100, which are the really big stocks that make up the Nasdaq. We've been seeing them underperform the rest of the Nasdaq. Now, you could see that as negative, that the big stocks aren't showing longer term leadership the way we would usually like, and that's kind of been why the S&P's been just kind of drifting higher, and we have a down day, then we drift back up again. There's not an awful lot of conviction behind the moves, and that's what we're seeing in our short-term indicators. That's the negative side. The positive side is, well, you've got the Nasdaq, which is a much broader index, and it's outperforming the Nasdaq 100. Oh, that's you can take that as more positive since more stocks are participating, at least at the NASDAQ level. Small caps and mid caps actually outperformed the S&P 500, and they like the idea of rate cuts happening because small and mid cap companies have to borrow more money. And if that money's going for interest, that cuts into their profits. If it's not going for interest, they get to keep that as profits and they can put that back into their company and hopefully become large cap stocks instead of always being a small or a mid cap. Then there was some Fed speak that came out. Chicago Fed President Goolsbee stated that he has not made up his mind about a rate cut. Okay, I'm just going to dangle it out there and tease you a little bit and say, we might not, citing a need to control inflation. Now, the statements that we were hearing from other members of the committee throughout the week was mainly pointing to employment. This statement focused more on inflation, and he thinks that we should turn the focus to inflation entirely before turning entirely over to the labor market. Okay, so just a few things here on a short-term basis showing more positive conviction. The CCI 20, which is strange, it's a little bit longer term. The CCI 14 was on this list earlier in the week. It fell off. It hasn't come back on yet, but the CCI 20 has. And then our stochastics chart as well. And we're still extreme here. We came down a little bit with the Chaikin oscillator. We haven't crossed below the moving average yet to turn it negative, but we're still getting an extreme reading, and the Sean trend meter is also extreme. So I haven't changed the scenario here because nothing really has substantially changed, but it does look like, well, it is pretty much 100% probability, and the Fed should follow what the market says that there will be a rate cut with a high probability of it being 25 basis points. The dollar was down, which could have helped stocks, but kind of helped them from maybe not declining more. Interest rates really dropping. We're at 4.09% with the 10-year yield. Just about a week ago, we were at 4.28%, and now we're all the way down to 4.09%. That's quite a drop there, where it was even a drop down to 418. That was a big drop, and now we dropped even more in that regard. And sentiment not changing all that much. You got a lot of folks that it's like, okay, the market's going up. We're either setting intraday all-time highs or closing all-time highs with the S&P, but they're still worried about things. And so as far as sentiment, that is more neutral. We did tick up just one notch. And we're positive with the trend, but it's a weakening trend. Now, in the short term, we're still below 20, so we're not trending in the short term. We're declining. We're seeing a weakening trend in the intermediate term, but both the short and intermediate term are positive. And with this should be, yeah, it should be negative with the bias since we had the down day, and I'm switching the momentum back to mixed. We're positive in the bigger picture, but the momentum is the last 2, 3, 4, 5 days taken together. And even though we are going up and we're above the 20 period moving averages, we're seeing some internal charts that some are negative, some are positive. So that's why I came to a mixed conclusion. Okay, so this was the big economic report of the month. Non-farm payrolls, 22,000, a lot less than the 78,000 they had expected last time. And we've been watching these revisioned numbers here. Prior was 79,000. They actually revised that up. Now, what we've been seeing in the last report and what really freaked the market out when we got the August report was that the revisions were coming to the downside. This time they actually went to the upside. Non-farm private payrolls also much less than expected, 38,000. They thought there would be 90,000, and they were this one was actually revised down to 77,000, where it first came out at 83,000. Unemployment rate at 4.3%. Last time it was at 4.2%, so that did tick up a notch there. Average hourly earnings came in as expected, up 0.3%, and the same as what we saw in the last report. The work week ticked down 34.2. They expected it to come in at 34.3. Last time it did come in at 34.2. All right, so I have some different kinds of charts to show here. The non-farm payroll change, positive, but really dropped off here. And that's what the market had anticipated. And so that's why we were keeping things positive and actually going up. And then when the report finally came out, the market decided to sell off. All right, the hourly earnings also declining on a year-over-year basis under that 4% level. Then showing just some different context here where we got the initial claims, that's the red line, and they're going up, but we're still range bound. And then we have the continuing claims, which are high in a higher range, but they're in a range. They're kind of going sideways. And now with the updated unemployment rate coming in at 4.3%. And we have a series from a source called Real Investment Advice that posts these on Isabel Net blog charts. This is looking at oil prices and events. Okay. And that's why we watch oil, is mainly for geopolitical reasons. And so things happen, oil tends to move, but we haven't seen much of a move here when the whole Israel-Iran thing started to happen. We've actually been drifting down, and oil declined again on Friday. And investors' allocation to equities is at an all-time high. Not a surprise there. The stock market is the place to be. Equities, those are stocks. Debt, those are bonds. And then cash is cash. Sometimes cash is king. And then I'll go over this again, not this chart, but I go over this once a week with the intermarket analysis video that I do. We look at the valuation of the S&P, and there's a variation of that called the CAPE, which was developed by Robert Schiller, with the 10-year yield returns, real and nominal, mean inflation or just the change in those values, and high and low valuations points. Okay. Then 10-year real yields have been negative for the last major peaks. Okay. Somehow there's some kind of insight coming into this chart. We just kind of watch interest rates for what they are and how they have an impact on the market. And then the composition of 87 trillion in the global equity market. So one of the few places you actually see more worth than debt is when you look at the value of stocks, with 65% of that coming from US stocks. And then share the top five companies. We have other charts that show the top 10, and we have the Magnificent Seven. So they kind of jockey these around. And then this is throughout history, what has happened. And right now, the big ones are Nvidia, Microsoft, Apple, Alphabet, which is Google, and Amazon. And sometimes I refer back to the dot-com boom and bust. You can see here, Microsoft's still on that list. They've been there. They kind of come and go a little bit, but they're usually in the thick of it all. Cisco, which is not on the list anymore. GE, which was the last surviving member of the Dow. It was in the original Dow. They finally took that out, Intel and Exxon, and those aren't even on this list now. And things kind of come and go in that regard. And tech earnings have grown faster than the market in the last decade. This is why folks get into tech. That's the big growth area. And we're seeing earnings really going up. And both, whether you look at just world technology altogether, um, or if you break that out, they still trailing behind a little bit here as well. And then the PEG ratio. This is a little different way of looking at valuations here between the US and the rest of the world has diverged in recent years. So you can see that the US, according to this ratio, is also more expensive than the rest of the world if you take out US stocks. Then this comes from a little different source here. The non-farm payrolls, job gain diffusion across private sectors is recessionary. Doesn't necessarily have to be, but they're trying to make a black and white statement here. And we're seeing that coming up, but not really looking too inflationary at this point. Because if they're creating a lot of jobs, especially in the private sector, well, people are making more money and they go out and spend that money. And places where they spend that money can raise their prices, and that can turn around to be inflationary. And the unemployment rate, now, what we usually see here is more of a pared down unemployment rate coming in at 4.3%. But then you have the broader U6, that's up at 8.1, and they've been inching back up here a little bit. Now, some folks really focus on this. Politicians do, the financial media does, because it's one simple number that you can throw out there to try to explain a very complicated thing. But a number of years ago, they changed how this was calculated, all these different unemployment numbers. Actually, the U6 is really more accurate than what we usually get. But there's so much manipulation in how this is calculated. It's like, is this number even all that useful? Doesn't matter. It's still used anyway. And then September versus the rate cut, just showing here, they're trying to back up here to the 1998 rate cut. And then what they're looking, and it was just a year ago when they came in and also made a rate cut at that time as well. And then how the market performed after that, because we have to know the context. All right, here is the chart. And we did gap higher. We got above R1 here, but this set an intraday all-time high and the all-time high on an intraday basis here, but not a closing high. And then not long after the market opened, boom, we fell down below the unchanged level to go negative. We went below the daily pivot, below S1. We found some support here around 64.50, and then we just kind of chopped up, came back down, and then saw some late day buying coming into the close. We still ended up closing lower and below the daily pivot, so it was a down day, but seeing late day buying coming in is usually taken as positive. And then settling down a little bit after we closed here, going to shut things down for the weekend. But again, we're still seeing most of the price action happening while the market is open instead of it happening with the futures, either up or down. And this is improving a little bit. We're seeing the blue line and the red line fairly close to each other, even though they were negative with the intraday large cap to growth or large cap growth and value chart. And this is improving also. We saw some weakness the latter part of August. We've been coming back up here with the intraday growth to value ratio for the S&P. So growth was down, but down less than value. That's why the ratios improved slightly. It was up more with the mid caps. It was unchanged with the small caps, and value was up. So value actually outperformed. And we've been seeing kind of a drifting off here when we look at small cap growth to value, mid cap growth to value going sideways below the 50-day moving average, and a tick down just a little bit here with S&P growth to value, but below its 50-day moving average. Even though in the bigger picture, this ratio is still in an uptrend and coming back up to the top end of the rainbow with this growth to value ratio and tick down a little bit with the discretionary to staples. This ratio has actually been performing better in the bigger picture, and that would be encouraging, and that's more positive for the market. So we're trying to turn back up, but we're still below 20 with the ADX in the short term. We're below the moving average. That means we're not trending, and it's still a weak trend until we either looks like we might do it at about the same time if this turns back up. Cross back above the moving average, that suggests a strengthening trend. And then if once we get above 20, that's a static number just to define whether we're trending or not trending. And still going down here with the intermediate term, which is where I really put the most focus on here, but it's positive with the green line above the red line. And we did actually go above average with volume. This is an oscillator, so we try to pick out over a period of a number of days what is volume doing, and it's really been dropping off here. But in Friday's session, we saw one little green bar here, which we haven't seen many of those lately. And we're still below the moving averages with the VIX. We're below 20 as well. And we did get a little bit above the moving averages, but we came down off of that with the bar chart. And we're still waiting to see if this is going to happen. So far, it has not materialized with the VIX seasonally. August into September, possibly into October, that's when we see the VIX really going up. It just hasn't been doing that because stocks have been going up. So the VIX has been under 20 and a lot of times going down. And we're seeing a drop off here with the volatility. We're below the moving averages with the bar chart as well as the line chart. We're still up in this red area. We've been kind of camped out here for a number of days where the market is anticipating some kind of a big move that apparently hasn't happened yet because we would drop down out of this red area if that move had completed. And bit of a contradiction here. We really declined with this fear gauge where we're going up just a little bit, not very much, but ticking up with this other fear gauge. And we fell off here with the equity put call ratio, which is kind of strange. Ahead of a weekend, market going down, we saw the puts underperforming calls on the daily chart. So we're starting to come back down with the 5-day chart and we're starting to come down with the 10-day chart. Now that's positive. When these longer term equity put call ratios are declining, that's a market that tends to be more positive. And coming down, but still above the band with volatility risk premium. So a little bit of fear coming out of the market there, even though it was a down day. Still holding up, but kind of going sideways now with the advanced decline line based on price. A little bit of a lag here. You can see we're back up to these previous levels based on price. We haven't come back up to these levels and declined a little bit here based on volume. And really, we ticked up just a little bit based on price, where we ticked down based on volume. And back above zero and going up with the short and intermediate term advanced decline ratio, above zero and going up, but it's been real choppy. Once we got about halfway through July, we go a little bit above, a little bit below, a little bit above, a little bit below. Now we're back to a little bit above with the advanced decline oscillator. And even though we're going down with the 5-day and the 10-day moving average, we did see an expansion of new highs, which probably happened right after the open when the S&P set the intraday all-time high. That's probably when a lot of those new highs were generated. And still looking pretty positive here. Even though we ticked down with accumulation distribution, we came down right back to the moving average. So in the bigger picture, we're still quite positive here. But in the shorter term, after we crossed above the moving average and we're turning positive, with the down day, we're coming back down to the moving average, which is turning us a little bit more negative short term. Still going up here though with the Chaikin money flow. The histogram continues to advance. The red line continues to go up. Now we're getting close to a point, and there's no magic of where this point is actually at, but we're starting to look a little overextended with the Chaikin money flow. Now the Chaikin oscillator, it did decline, but we're still above this green line and we're still above the moving average. So this is still giving us an extreme positive reading. And positive here with the vortex. The green line is above the red line, above the moving averages with all the different indexes that we look at. And we declined a little bit, but we're still above 50, still seeing that longer negative divergence. When we look at those stocks in the S&P above their 20-period moving averages, also a bit of a negative divergence with the stocks above their 50-period moving average, but we're still above 50 here. And not really a negative divergence with the 100-period moving average study, and actually went up a little bit, and we went up barely here, but holding up a little bit better with a series of higher highs when we look at the 200-period moving average study. And we're just above this monthly pivot point here. Now, the pivot point that I've been fixated on is on a weekly chart, which those pivot points are good for the entire quarter. But we are above this pivot point right now, and we're also above the daily pivot, which here would be the monthly pivot for this. So not a lot of conviction in this move, but you could make a case that in the shorter term, we're making a series of higher highs and a little bit higher lows here. So the chart's still looking fairly healthy. On the bottom, first time in quite a while, we've been above average with volume. So we went back up above 50 with the 20. We actually ticked down a little bit, but we're still above 50 with the 50-period moving average study, and a slight decline and well above 50 with the 200-period moving average study. We came above the midpoint with the Stochk RSI. Now we're falling back down below the midpoint. And this is showing the lack of conviction. When the market really gets moving, we're either extreme positive or extreme negative. We're not seeing that now with the Stochk RSI. And we were extreme positive with the Williams percent R, but with the down day, it's now dropping from being extreme. And this is the shorter term CCI chart. We're just barely below 100, where we're barely above 100 with the little bit longer term CCI 20. And coming down with the short-term stochastic with the down day, but we're not quite below the moving average yet. We're still going up and looking more positive with the intermediate short term. We're declining with the long short term below the moving average, but it's still giving us an extreme positive reading. And where we were a little bit above the midpoint with the force index, now we're a little bit below, but it's still above zero, so it's green. And you can see as we kind of started to slow down here, you can see these Keltner bands getting closer and closer to each other. You have to keep that in mind because this is like winding up a spring in a toy. The tighter you wind that spring, once it finally moves, either up or down, the move tends to have more of it can be a bigger move. All right, and looking okay now, not great, but okay with the condition of the short-term trend based on 20 periods. We're still kind of going up with the blue line and the green line. Yes, I know my colors. And we actually found the 20-period simple and exponential moving averages providing support in Friday's session. That's about where we set the low, and then we were able to come up off of that. And we're back down into the +1 channel with the standard deviations chart. We had gone up into the +2 channel. And then we started off the day in the +2 channel, but ended up in the +1 channel. But we're above the midpoint, and the midpoint's going up, so that's still positive there. And going back up with the balance of power and still above zero, so that's looking more positive. We're positive with the go, no go, dark blue bars above the midpoint, even though we declined with the highest high value chart. Now we're on day 88 of this current trend that began back at the beginning of May. So that's a uptrend there. We're also looking at a positive trend with proper order. But this is where we're seeing a bit of a negative divergence. We've not really shown a lot of conviction here, but we have been going up with the S&P. Well, near the end of August, we started to come down with the TTM squeeze, and it's actually turning more negative when we see that red dot. And still just barely above zero with the ease of movement. And you can see going through the summer months, we just kind of were just flatlining here for the most part. We saw a little bit of an improvement here with the Arun. The green line went up, the red line went down, so the oscillator is going up, showing that buyers are in control. And we did improve with the S&P McClellan oscillator, but we're still below zero. And when that's negative, we're still declining ever so slightly based on price. We're declining with a bit more conviction based on volume. We actually turned back to positive here with the NYSE McClellan oscillator. We rose up and came back above zero. So very choppy, but starting to go up with the summation index based on price and volume. And we're seeing a mix here. We're going up with the swollen trading oscillator based on price. We're still declining with the swollen trading oscillator based on volume. Momentum is still drifting down here. We're negative with the PMO, holding up a little bit better based on price, but seeing a little bit more of a downward move here based on volume. And we decline and we're below 50 with the PMOs that are rising after that had been improving. We're right at 50 with the buy signals. That's the tipping point between positive and negative. And we're still leveling out here above 50 with the PMOs that are above zero. Still positive with the Elder's Impulse system, even though it ended up being a down day. We're positive with the parabolic SAR now for the second day. But then we look at our momentum oscillator. Short-term slope oscillator, declining. That's negative. MACD, still below its moving average. Everything is still going down for the most part. That's more short to intermediate term. That is negative. So our two short-term oscillators are negative. Our three intermediate term oscillators are negative, and we're still declining with the Trix and KST, our two long-term oscillators. Still negative with the Copic Curve momentum oscillator. Coming down, but still in this green area with the Sean trend meter. That's why it's still extreme. But the context now is that it's declining. And we're back above 50 with the money flow. And we decline, but we're still above 50 with the ultimate oscillator. Still above the moving average with on-balance volume. Still above 50 with the RSI. As I've been trying to point out, as we've been going up with the S&P, we're seeing a series of lower highs here with the RSI intermediate term as well as the short term. That's another negative divergence. And we're still above the short-term trend here, the 10-period simple moving average, this fluorescent green. Even though we were down, most of the price action happened above these moving averages, so they're still going up. And then the condition of the intermediate term trend based on 50 periods, rolling over just a little bit with the red line, but the blue line's still going up. We've been spending a number of days now below these lines, and that's showing a little bit of vulnerability, but not enough to have the lines roll over. Still above all the plotted moving averages here, and the lines continue to go up. Again, you can see how the 20-period moving average acted as support. Still declining, though, with the bullish percent index. Now, it was up, but not enough to get back above its moving average. And going back up and above 50 with the NYSE bullish percent index, we did go up with the NASDAQ 100 bullish percent index, but we're still below 50. So it's negative, but improving. And then the Pring Bottom Fisher, which got generated about halfway through August, that's still on the books for right now. And still above the little mini rainbow, when we look at the 20-period simple moving average of the open, high, low, close, we came down here. This acted as support, and we were able to close back above the mini rainbow there. This is the big chart where we closed a little bit above this R1 level. We just couldn't seem to do that for the last number of weeks. Now, it's not like we're way high above it, but this R1 point is at 64.68. We closed at 64.81. You could round it up to 82. So we are above it right now. So what we're going to be watching for is, can it hold onto this? Is this going to be able to launch up and go even higher from here? And we're still at the top end of the rainbow, not rainbow, the trend line here going back to 2009. And so looking more positive with the hike in ASHI, even with the down day. We're still positive with the Kegi chart, black and pointing up, positive with the Renko chart, and positive with the three-line break. Seeing a bit more confirmation there. Even though it was a down day, the trends are still intact for right now. Long term, still looking pretty healthy here with our 150 and 200 period moving averages. Positive on all time frames across all the different indexes. Bonds are positive, and with interest rates going down, that means bond prices are going up. So we're seeing some real improvement here in the short and intermediate term. We've now switched over to a downtrend with commodities in the short term. Even though the dollar's been holding up fairly well, we're negative across all three time frames. And you can see here, real estate, materials, communication, those were the areas that were up. Staples ended up being up. Energy is the one that really got hit. And financials, we've been a little bit encouraged seeing the ratio between the financial sector and the S&P improving. Gave a lot of that back in Friday's session, and I'll show you that chart. So started off the day really positive. You can see the time over here. This is 2 or 3 minutes right after the open. Of course, Canada, another day, another all-time high there. We did set an all-time high intraday with the S&P as we did with the Nasdaq, but the Nasdaq 100 did not. The Dow set an intraday all-time high, and then Canada set an even higher all-time high above 29,000. And then we saw weakness later on here with the Nasdaq crossing below 21.6, and the financial sector had a bearish MACD crossover. We want to keep an eye on that. As the financials go, the economy goes. And if the financials are doing better, generally the economy's doing better. And we were seeing this gradual shift throughout the summer months. It was starting to improve. Now it's starting to show some weakness again. And we had a BPI cross above 50 with the tech sector. And that's growth and that's more positive. So the big stocks, more red here. Nvidia, Microsoft were down. Financials, not a good day there. Awful lot of red with little oases, I guess, of green in here somewhere. And then we had Tesla was up, but Amazon was down for discretionary, and then communication. Both Google and Meta were up, but not by real strong amounts there. Here is the Dow. It set an intraday all-time high, but not a closing all-time high. Starting to drift sideways here. And we've gone from positive over to neutral with the diamonds, with the Elder's Impulse system. Here's where we set the intraday high with the NASDAQ, but then we closed down off of that. And still positive though with the Elder's Impulse system for the NASDAQ. And we didn't set an intraday high here with the NASDAQ 100. We opened higher. We ended up being virtually unchanged on the day, but not setting a new all-time high. Still positive with the Qs, looking at the Elder's Impulse system. Improving, but still negative going back to the end of May here with the momentum for the NASDAQ 100. That's what we've been seeing now month after month. And still above the 20 period moving average with the QQQs. Long-term trend line going back to 2009, still holding up fairly well there. And looking better here with the S&P small cap index. They were up. I mean, when they say they outperformed, they were up 0.29%, where the S&P was down 0.32%. So it's not like they're just, massively outperforming. But this chart is looking a little bit better here, but still quite choppy. And we were up 0.5% with the Russell 2000 small caps, possibly seeing some kind of a breakout now that it's looking more certain that the Fed is going to cut rates. Positive with the Elder's Impulse system for the small caps. Seeing an improvement here, up 0.5% with the mid caps. Positive with the Elder's Impulse system. The Wilshire not back at an all-time high. It set an intraday all-time high, but not a closing all-time high. And same thing here with the total U.S. stock ETF. New intraday all-time high, but not a closing high. Ended up being down slightly. The financial sector, down. It got hit pretty hard here, but still above its 50-day moving average. And this is what I'm talking about. We've been seeing this drift lower with the financial to S&P ratio. It was starting to improve, got back above its 50-day moving average, and then just tanked with this ratio on Friday. And setting a new all-time high with the FANG index. So the really big stocks, they're the ones that are continuing to be in control of the market. Apple was virtually unchanged, but down slightly. Amazon was down 1.42%. Below the 50-day moving average, down 2.55% with Microsoft. Coming down still above its 50-day moving average and up 0.5% with Meta. And Google still looking pretty good here, setting all-time highs. This is where a lot of the strength is coming from right now. Nvidia dropping further below its 50-day moving average. And Tesla was up 3.64%, but it's been so choppy lately, but it's back above and has been above for the last few days, above both of the moving averages. Netflix was down a percent, but still above its 50-day moving average. And seeing a bit of a pickup here when we look at the relationship between US and world stocks in the short term, kind of going sideways after declining slightly with the longer term correlation. Dropping with oil, that's not inflationary. We're actually coming down into the low 60s now. And the dollar just kind of do above and below the moving averages here. And this is where we're seeing a really big drop off with the 10-year yield really coming down. We fell down below this range and actually came down below that. Now we're starting to come down and fall below this other range that we were seeing back last spring. Are we going to come all the way down here and actually drop under 4%? Who knows, but at least the trend seems to be showing that right now. So we're really going up. And what we're more concerned about here is, are we going to become overbought with the 10-year? Now notice we closed well off of the high there. We opened, we set a high, and we closed at the low after gapping up with the 10-year based on price. But we're starting to get extreme with the RSI. However, we're still positive with the MACD, which measures momentum, and showing a little bit of an improvement, but still below a declining moving average when we look at the Qs to S&P. Discretionary to the S&P, still above an advancing moving average, and we're right back up to the moving average when we compare large cap growth to value. So when we just break out the large caps above the moving average, still below a declining moving average with the mid caps and the small caps. So what's the outlook? We're still positive on all three time frames. And for now anyway, we're above overhead resistance. The longer we can stay above that, the more solid that will become. Because when we just break above it, now it's like, okay, there were probably a lot of stop loss orders for shorts that said get out if that happens. And it's very common it's called gunning for stops. And they drive the market in one way or another. They clear out all those stops and then they reverse and go the other direction because they're planning on some kind of an overshoot to take out those stops. But for right now, we're looking more positive. We're above that long-term resistance. And we're gonna, okay, I didn't update this. So let's go look at the new calendar. We're gonna get consumer credit on Monday. We're gonna get nothing on Tuesday, which is kind of strange. Usually the days where we don't get anything is either Monday or Friday, but this week it's gonna be Tuesday. Then we've got some inflation data coming out. Now we're gonna get PPI first this time. The last report we had CPI first and then PPI. Now on Wednesday we're going to get PPI and then CPI on Thursday. We'll also get consumer sentiment on Friday. And then nothing really all that major until we get to Wednesday's session as far as the economic reports. And no real lean in one way or the other. With the Dow, we're neutral to positive, as well as the Nasdaq, where we're neutral to negative with the S&P when we look at September 8th going back to 2002. And this shows September historically has been weak, even though we really have yet to see that. This also shows weakness in September, but hasn't really materialized to this point, where we still see the first half of September performing better than the second half of September. Also, some seasonal weakness that just has not developed, at least to this point. And also going back to 1950, showing how the S&P underperforms in the month of September. All right, so we're back to negative, even though we're improving with the S&P McClellan oscillator and summation index. They're still below zero. We're still negative with the momentum indicators. We're mixed. We're going up a little bit based on price. We're declining based on volume with the Swindle trading oscillator. Bullish percent indexes, we did tick up with the S&P, but it's still below its moving average. Looking a little more positive with the NYSE. I don't put a moving average on that, but we're above 50 and we ticked up. Improving, but still below 50 with the bullish percent index for the NASDAQ 100. Momentum continues to be negative for the NASDAQ 100 there. And our smart money indicators, we came down a little bit. In the short term, possibly we're a little more negative with the boom indicator. But in the bigger picture, the accumulation distribution is still positive. Chaikin money flow continues to go up. We declined and we're extreme here with the Chaikin oscillator. Growth to value ratio is still looking good in the bigger picture. Little more weakness that started to come in once we hit August, and that's continuing to develop. Where the discretionary to staples ratio has been holding up much better. And then we're positive. We're back above zero with the NYSE McClellan oscillator and summation index. Parabolic SAR is back to positive, and the NYSE bullish percent index. That's why I have it on both sides here because I don't put a moving average on that, and it's above 50. That's why it's positive. Ease of movement, money flow, and ultimate oscillator. Those are in white. They're secondary indicators. They are still positive. The vortex is positive, and the financial sector by itself, but I've been saying this over and over and over all summer, and now getting close to being fall, it's still continuing to underperform the S&P. And we have a praying bottom fisher buy signal just kind of looming in the background there. And then the long-term special K chart, which long-term on the daily side and it's even longer on the weekly side, they are still both positive. All right, here are the pivot points, which have been updated on the YouTube community tab and also included on the website. Okay, so our conclusion, positive, above overhead resistance, can it hold? Short term, there's no conviction. There's just nothing developing right now. We were leaning more positive as we were coming up to Friday session. Then we had the down day. Now we're back to not really showing much conviction with the 20 period moving averages providing support. Intermediate term, there are some areas that are looking stronger, but there's also some areas that are looking weaker at the same time, but we're still positive in the longer term. Thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.